interest rates are on the rise, and then they're not, and everything's scary, and then it isn't, and the news says this, and the news says that. Let's hear it from a professional. Sometimes life just sucks, and sometimes it freaking rocks. We will discuss all the things from family and real estate to travel and just life in general. So take a seat, or don't, you do you, and welcome to the Lambadass Podcast. Welcome to the Lambadass Podcast, Josh Stuart.
Oh, thank you for having me.
Of course. So I feel like I should let the listeners know that Josh is a very good friend of mine. He's a good family friend of ours. Our families are very close. I love his wife. You love Sweetie Pie. We're just a family match made in heaven.
Good fit.
I agree. But you are also my lender.
Yes.
And I don't mean like my lender, like just for my clients, like my lender personally.
Yep.
So I am super grateful to have you here today because I think there's so much going on in real estate right now, and mortgages are huge.
Yep.
And they're proving to be quite difficult right now. I also think that there's a lot of news media pushing out the narrative of being scared and worrying and all this stuff. So I kind of want to know from your end, wait, before we even go down this, I have to tell everybody how we met because how we met is normally not the way real estate agents meet professionals that they work with. I don't think. Do you? Do you meet a lot of agents that way?
Yeah, through transactions like that.
Yeah.
That's usually how I meet most of my, because then it's kind of like you have that first transaction and then you kind of prove yourself. Like that's why it's kind of hard for a lot of loan officers to get into the purchase world.
Yes.
Because they can't just like, hey, use me for a loan. It's like you almost have to have that first test deal.
But they do.
Yeah. So if you do a bunch of refis, you never really do purchases, and you'll come across probably 70% of LOs do almost just nothing but refis.
That makes perfect sense to me, actually.
Yeah.
But so from the real estate side, I will tell you, most people just come in and are like, I'm good, use me. Or another real estate agent will say, hey, this is the lender that I use. This is the title company that I use. You should use them too. And so that's how it gets around.
Yeah.
But you came to me because I had a client, we had a mutual client.
Yeah. And
they wanted to purchase a home. It was a bank-owned property.
Yeah.
This was years ago when foreclosures were a real big thing. And And as an agent, I have to tell you, when somebody tells me I have my own lender, I'm like, do you really? Do you really like them? And I will work with anybody because, I work with buyers that don't use you.
Yeah.
And I work well with others and all the things. But when a client says that to you, you're just kind of like, oh, shoot, this is going to go one of two ways.
You never know what you're getting.
Not at all.
Yeah.
And you were so good at communicating. And it's funny because on a foreclosure property, generally speaking, the bank wants to get rid of the property. So they're like, hurry up and close this deal. You were ready to close before they were. I remember the listing agent was like, he's ready to close. And I'm like, well, yeah, I know the contract says 30 days, and it's been 25 or whatever it was, but we're ready to close. So whenever you are done, we're done.
Yeah.
So
I think the end of 2011.
Is that when it was?
Yeah, I think so.
Oh, well, happy almost anniversary.
I know.
Candace and Sweetie Pie are so lucky that we're friends.
Yeah.
But anyways, with that said, you were my go-to afterwards because just your communication and just, hey, what's going on? I also love that you'll call and check on me. Hey, everything good? How's the fam? Everything's great. Okay, how's business? Are you doing good? What are you doing next year? I like kind of like the masterminding that we do, in the 15 minutes that we have to chit chat. So I totally appreciate that aspect of our friendship as well.
Yeah.
But I want you to let the consumers know what is going on. What is it that you're seeing with these interest rates, with what the news is saying versus what is actually happening?
So interest rates obviously are going up. Everyone knows that. That's all over the news. It was due to the Fed hiking interest rates to combat inflation. Mm-hmm. That was initially what was happening. And then I believe in July was their last increase. Some are forecasting the last increase that they'll do. You never really know what's going to happen, especially with everything going on with Israel and stuff like that. That can always shake things up for what the Fed is planning. But for right now, that looks like the last rate hike.
So explain, dumb it down for me.
Okay.
What does inflation have to do with, for somebody who's listening who doesn't understand, what does inflation have to do with the interest rates on a home purchase?
So interest rates in general is liquidity, buying power, and liquidity in the economy.
Okay.
So when rates are at 2.5%, you can now afford double your purchase power, not just with homes, but with just a lot of things. When car loans are at 0%, all of a sudden you can afford, X amount of vehicle. When car loans are at 6%, now you have to tighten up a little bit. And that's what inflation is. Money is kind of running away. Everything is going more and more and more expensive as we're seeing that.
So they're doing that to decrease consumer spending.
Yes.
Got it.
And also raise unemployment is usually a factor
okay.
in fighting inflation, raising rates. There's always going to be job cuts. We kind of are seeing that this year, and we saw that last year quite a bit with the tech world. That and they need that. They need that unemployment to go up and the economy kind of to take a step back, and that's their job right now.
Okay, so you say unemployment needs to go up, meaning more people need to be unemployed.
Yeah.
Okay. So as the average person, that scares the hell out of me. So my thought is, well, why the heck would I ever buy a home if we need unemployment to go up? Like, what in your professional opinion keeps you, the average Joe, buying a home in the market that we're in now?
So, a lot of people, like one of the first common questions are, what's the interest rate? Yep. What's the payment? But right after that, a lot of people ask, is it a good time to buy? Mm-hmm. And if you're buying an investment property, then, in my opinion, value and how much money you're going to get back per month is important. But if you're buying a primary home and you're getting out of the rental market, I think you just need to buy a home.
I agree.
And as you mentioned on the podcast, if you can afford the payment, then it makes sense. Number one, you're going to get the write-off of having a home, which is huge, especially if you're making over six figures. You need those write-offs, and then also if just planning a family. Not having to move because your landlord is selling a property, not having to change your finances because your landlord raised the rent again. Some rents are going in 2016 for $1,600, and now it's renting for $2,600.
That's so crazy.
Yeah. Where if you would have bought, you maybe would have bought for a payment of $2,000, but your payment would still be $2,000.
And it's funny too because hindsight is 20/20, so they say.
You never know. Yep.
But even when we bought our house in 2016. We closed escrow on October 17th, 2016. Mm-hmm. And I remember thinking, oh my gosh, this is an election year.
Yeah.
We have it good where we're at. I'm going to wait for home prices to go down, I think. And obviously this was before we closed. And David came to me and he was like, Laura, what do you tell your clients? If you can afford to buy the house. I really think we should buy. Yeah. But I'm going to tell you, even as a real estate agent in 2016, I thought the market's going to fall and I need to just wait. And we were socking away money.
Yeah.
So I thought that was the best thing that I could do. And it's funny because I wasn't in a business mindset then. I was more in the mindset of trying to survive, right? Yeah. And wanting to make the best decision for my family. Yeah. But I think these people constantly waiting for this crash to happen just is not a good financial decision. Any way you look at it. What are your thoughts?
Well, yeah, there's always going to be a reason why not to buy.
Yep.
Let's wait. And when we met on that transaction, I thought that was a horrible time to buy. I didn't think the market was done falling,
really?
And it ended up being one of the best times to buy.
It was an insane time to buy.
Because then in 2012, rates skyrocketed down for the first time since 2008, and values shot up. And then same thing in 2016, rates went down quite a bit, values shot up, and it's kind of been on this cycle. And then 2020. Rates shot down, as everyone knows, and values skyrocketed up. So if it continues that trend, then probably 2024 rates are going to shoot down economically because of the economy, and values are going to go back up again.
So then trends is just something that you totally look into.
Yeah.
So then in your opinion, it's better buy a home now than in 2024.
Yeah, because as you saw, and I went through, because I bought a home in 2021.
Right.
But everyone thought the market was going to crash in 2020.
Right.
Ended up not crashing, and then in 2021, we have all the people that needed to buy in 2020 and all the people that needed to buy in 2021. So the market was just insane.
And we still have those people because they've just been priced out of the market with these crazy interest rates. Yeah. Somebody was saying the difference in interest rates from what they were versus what they are now, it's a difference of like $1,500 a month in payment, depending on what point you're looking at, obviously.
Yeah.
But okay, so if you're telling me now's a better time to buy than next year, but you just got done telling me that we need more unemployment. So my mind is like, well, if they're going to be laying off more people, why would I buy now? Why wouldn't I wait until those people are laid off and have to sell their home? And I think I can answer my own question, but I want to know what your thoughts are.
Well, so that is a possibility, but it kind of depends on how much unemployment's going to increase, how much we can push rates up. The Fed has all that debt, so that's an annual. Just the interest on the debt now is like our full GDP. I've been told. So it's like they need rates to be low as much as we need rates to be low, and we've had a few bank failures, so they can't push it. It's like a fine line. They want to push it up to that before the economy crashes, and then pull back.
Got it.
And lowering rates is the one thing that they have to fight the economy from crashing. Same thing they did in 2008. Same thing they did in 2020. They did it all through the early, after 2008. They kept rates low historically for like 6 or 7 years, but so once the economy starts slowing down, they're going to use those tools to lower rates again. And if you're already in a home, then you just refi to a lower rate.
So smart.
Yeah.
See, and my thought is, okay, if I buy a house now and then people start losing their jobs and stuff like that, like the reality is the people that lose their homes are still going to have equity.
Yeah.
Right?
Yeah.
Assuming they didn't pull every penny out when rates went low. If we just assume that somebody who bought I use myself as an example on one of my Instagram stories, and it's like my property value would literally have to decrease by 50%, cut in half, in order for me to break even. And even then, because I've been paying my mortgage, I've paid that down some. So if I paid $250 for my house, I did not, but if we use round figures, if I paid $250 for my house, I'd probably owe around $240, $230 now. And if I could sell for $500 now, it literally has to go down to $250 before I'm really in a bad spot.
Yeah.
So if it gets to the point where I'm not selling any more houses and everybody says, forget Lombardos and Associates, we're not using them for our real estate team anymore. Well, I'll sell my property here and I'll go sell real estate somewhere else. And I think that's the general consensus for a lot of people. Well, if I lose my job, I still have equity in my house. I'll just sell it and I'll take that equity and I'll go somewhere else and find a job elsewhere. If it's not in the state of California, fine, I'll go to Idaho, Tennessee, Florida, all the places that Californians are going.
Yeah, and if one person loses their job and the other person doesn't, they still can qualify for something cheaper in another state if that's what they choose to do. But also you have unemployment. There's a lot of safety nets, especially in California, to live off of until you find another job.
True.
And the one big thing that's different from now compared to 2008 is 2008 people couldn't afford their mortgage payments.
True.
They weren't qualified off.
I would tell everybody, if you have a heartbeat and a social security number, congratulations, you too can own a home.
Exactly. Which is nice because it was fast and easy and quick, but it's just a different world. Like nowadays, you can't go above. Usually, you can't go above 45% DTI, but there's a few programs that will list above can go up to 56.
So let's break that down. What is DTI? What does that mean?
Your debt to income ratio. Yeah. So what ends up happening is we take your gross income and your debts, including your mortgage, including insurance, including everything else.
Child support, credit card payments. Okay. Pretty
much everything but utilities and stuff that's not reporting on your credit report.
Sure.
Can go up to roughly 45% is where your total debts can be of your gross income.
So to make this completely easy to understand, if you make $100,000 a year, 45,000 of that can be debt. Is that what I'm understanding?
Yeah. So like 120,000 would be a better example. So $10,000 a month.
Okay.
$10,000 a month. You can have $4,500 in total debt.
Perfect. Okay, so if you make $10,000 a month, $4,500 of it can be debt, and that includes mortgage, car payments, whatever,
anything on your credit
cards.
Report. Yep.
Okay.
Yep.
Okay,
yeah.
So that helps things out.
Yeah.
So you're saying, and I'm sorry, I didn't want to cut you off, but I want to make sure that you make it easy to understand for the average Joe.
Yeah.
So There are some programs that you said can go up to 56%?
Yeah, government programs. So it gets a little more complicated. FHA will allow you to go up to 56%, and then VA is a little different of an animal. They'll actually look into your affordability. So if you make, let's just say, $3,000 a month, and at the end of all of your bills, you have $100 left over, then they might not qualify you at a higher debt to income ratio of like 65%.
Oh.
But if you make $20,000 a month and you have $5,000 or $6,000 left over after your bills, they might still qualify you at like 65% debt to income ratio. It's kind of a weird program, because they see, okay, well, you have plenty of money after, even though your payment is huge compared to your income, you still have plenty of money for your bills and food and necessities.
I kind of like that, though. I think because it's not cut and dry, it allows our veterans to have another shot, if you will, almost kind of like a case-by-case basis.
Yeah.
Okay, good.
Yeah.
I like that.
Yeah.
So then where are interest rates? Are we allowed to ask this question? Where are interest rates today?
Yeah.
I know it fluctuate.
So it depends. It depends on your qualifications, obviously, but the average interest rate right now is hovering right around 8%.
Okay.
Yeah.
And what is it on a secondary home?
On a secondary home, right now, you're probably looking at about 0.5% higher.
Okay, so like 8.5.
Yeah.
And then what is it on an investment property?
Investment properties is, so it used to be a primary residence and a secondary home were the same price, same rate, and same cost. But a couple of years ago, that kind of changed. So a second home and an investment property are about the same, about 8.5% right now.
Oh, okay. So not too crazy different.
Nothing too crazy.
Okay.
And then what's happening with rates, so even though the Fed, just to circle back, even though the Fed isn't raising rates, we're still seeing a pretty substantial rate hike, or at least long-term rates going up. The Federal Reserve right now is selling mortgage-backed securities quite a bit.
Okay.
And then also China and Japan, you probably have read that in the news, that they buy a lot of our mortgage-backed securities, but they're selling right now. So that's causing rates to go up. So like, just in the past week alone, we've gone up probably about 0.5% in rate. And
you think that that's because investors are just getting cautious of the market, or?
Yeah, a lot of things are going on, but yeah, so the dollar's strong right now, and then the Fed will every once in a while just sell its paper, what's called, because they hold a lot of mortgage-backed securities, so they buy it. So when you hear like the words easement, if you're the Fed's easing, they're buying mortgage-backed securities. So one way is they lower the Fed rate down to lower rates, but another way is to buy mortgage-backed securities to create a demand, and so they'll build up their amount of mortgage-backed securities, and then they'll slowly sell that off in the market.
Is it like they're servicing the loan? Is that what it is, or is that different?
A little different, but it's to create a demand for mortgage-backed securities, which improves interest rates.
Right.
Because
then you can sell them.
Yeah. So if you're like, for instance, for right now, you won't invest in mortgage-backed securities until you're going to get like a 6% return or something of that sort. Well, I would be happy with a 5% return, so I will buy a 5% rate. You're waiting for a 6% rate. Well, if all of me disappears, then mortgage-backed securities will keep going up until they achieve that demand of the 6% rate.
That's so crazy. I feel like it's, I try to make things as easy as possible when it comes to explaining things.
It's a little bit more complicated than that. But
it is. But then when you put all these components together, then you understand why things are happening the way that they're happening.
Yes.
So then your thoughts moving forward. I know that you think we should buy now because interest rates are going to come back down next year, which is great news, right? Because if you can't afford to buy right now, next year might be an ample opportunity for you to get into the market. But if you can afford to buy now, you recommend doing so and then refinancing next year. What do you see happening long term?
Long term, I mean, You never know. It's just
you don't have a crystal ball, Josh. Come on, everybody expects me to have one.
You never know, but at the end of the day, I mean, your worst case scenario is you bought into a home that you can afford, and you hold on to the home, and you've lived in this home for X amount of years.
Right.
The one thing we do know is values are going to be higher in the future, and that's there's no statistic that points to otherwise. It just will. And
well, and everything's cyclical. So I think even if prices do come down, and it's funny because I know that scares a lot of people, but here's the thing: from my business mindset, I'm thinking, okay, if I'm buying a property and I know that I'm going to live there and for 5 years, let's just say, and I end up having to stay there for 6 or 7, well, one of two things is going to happen. I'm either going to can live there longer than those 5 years, or I'm going to rent it out and I'm going to go move wherever else it is that I need to move for whatever reason.
Exactly.
And even if I have to hold on to that property and rent wherever it is that I need to be, I think that that's a great opportunity too. I know that a lot of people who invest in other properties but continue to rent where they live because they want to live down in Newport Beach, but they can't afford, a $6 million property. So they're going to rent that, and then when they can no longer afford that rent, well, then they'll just move. But then they invest elsewhere. So I think that that's a niche, if you will, that people are really missing out on. I don't run scared, but I know a lot of people do.
Yeah.
So how do we?
I mean, and that's a great idea because now you're building your portfolio and
Yep.
you can still refinance it in the future. I mean, like investment properties in 2020, I mean, you could get an investment property rate at 2.75.
Yeah.
It was like, you know what I mean? So
I got it.
Yeah,
Thank you.
yeah, you're
I got
welcome.
2 actually.
Yeah.
Appreciate you.
You're welcome. So I mean, so rates will come down, and I don't know if they'll ever hit the 2s again, but it is very common to have rates in the 3s and the high 3s, low 4s, and I don't think we'll hit that anytime soon, but I think we'll definitely hit probably low mid 5s by the spring of next year.
When was the last time interest rates were at that 5.5% range?
Just last year.
Shut up! Seriously,
Yeah.
I did not think that was the answer you were going to give.
Yeah, no, it's been a wild year. Yeah.
Well, and it just seems like last year they were at 5.5%. That's insane.
Yeah.
That seems so crazy to me.
Yeah. So everyone hears 8% and be like, oh, it's going to take forever to get down to 5.5%, let's say.
Right.
But just like this last week, we went from probably 7.25%, 7.5% to close to 8%. Just in a week. Like it moves quickly, so it moves up quickly and it moves down quickly. So once that's the theme of rates, it seems like that's just okay. Well, we're buying mortgage-backed securities. You know what I mean? That's the popular thing to do because they know it's going to improve. They know the yield is going to get better.
So the last thing you said made me think of something. So how does a buyer know when to lock in their interest rate? Is that something that you kind of just do on your own, or do you wait for your clients to lock it in with you?
So for my clients, specifically, and every loan officer is a little different.
Sure.
Some loan officers, we have an approved purchase contract. Everyone's happy. Let's just lock it in. And sometimes I'll do that as well.
Sure.
Especially if the market's uncertain. But like for instance, if you see, rates just skyrocketed up this week, we're probably going to have a positive week this way because a lot of times there's that overreaction and then the pullback. Like for today, we're having a positive market. So which means
rates are going down.
Rates are getting better today. So like for instance, I got a purchase accepted on Thursday. I didn't lock them in because we just had just a gut-wrenching week, you know what I mean? So I'm not going to lock them in. So I let them know, like, hey, we've had a horrible week in rates. I know you just got your purchase accepted, but let's see what happens on Monday and see where the rate's going. If we have another but negative day on Monday, then we'll lock it in. If we have a positive day, then we'll kind of cautiously float. And so that's what we're going to do because we just had we're having a really nice day today.
Oh, that's good to know.
Yeah.
And this is all as of October 23rd, just so somebody doesn't come to me November 1st and like, what the heck? And interest rates are 25%. Not really, but okay, so that makes me feel good. So then you're constantly looking out for their best interest. And then when they say, okay, lock it in, We lock it in. Now,
Yeah.
I know there are times when that can fluctuate too. So we lock it in, but then we're able to come down a little bit. How does that work?
So if rates ever change drastically to where you can float down by, it's called a float down, but if you can change the rate by a quarter.
Okay.
So if we locked at, let's say, 8% and the market has shifted and we can get 7.625 for the same cost, then we'll do what's called a free float down and lower your rate.
And you can only do that once during the transaction. Is that correct?
Well, usually because it's a 30-day lock, it's very rare you have that big of a movement.
Okay.
I've never had that happen where you float down more than once.
Sure.
But I'm sure you probably could, as long as you floated down and then met that over a quarter again.
Got it.
But you would have to have the rate change almost at that point, almost a full percent in a 30-day period.
And the chances of that, I would take
very
it, are very rare.
Yeah.
So now we also talk about buying down the rate.
Yes.
So if my client wants to buy down the rate, do you recommend that or do you not recommend that, and why?
So I'm not a big fan of buying down the rate.
Ever? Like never ever?
Very, very rarely.
Okay.
Unless I mean, at the end of the day, if you have after your bills $100, you know what I mean?
Mm-hmm.
And it's like, okay, well, if I buy down the rate, I have this money in my bank, but now I'll have, $300, you know what I mean? Then yes, definitely do that to have that more of a cushion.
Right.
But in general, it usually takes about 3.5 years for you to recoup your cost of buying down a rate.
Okay. That's on average?
On average,
Okay.
yeah. So, most people, especially now, are going to refinance within the next 12 months. Like I don't really forecast a single person to be in their current loan that I get them this year by the end of 2024.
What about the people who did like the 2-1 buy downs? Because I feel like those people are still in a good position.
Yeah.
And I feel like they might be in a good position for a hot minute. But once that third year comes, I'm cautiously optimistic that they'll be able to refinance. But if they can't, I think we might see another surge in homes coming on the market because they were able to live in it for 2 years at the lower rate, right?
Yep.
But and just to further go into this, so 2-1 buy down is when the seller paid for the buyer's difference in rate for years 1 and 2. For example, if interest rate was 6%, the buyer's first year is going to be 4, second year is going to be 5. The difference in interest, it was actually paid for by the seller. So technically it was 6% all along, just the buyer wasn't paying for it. I guess, is that the easiest way to explain it?
Yeah.
Okay.
The weird thing about that loan is you're going to see 6% on all your documentation. It's really, really weird. You'll see the seller credit on the breakdown. You'll see that.
Sure.
But we don't disclose like a 4% rate for your first 12 years. It's not like
12 months, you mean?
Or 12 months, sorry.
That's okay.
It's not like an ARM where it's truly 4%. It's truly 6% the entire time, the life of the loan.
Yes.
But that money supplements your payment for the first 2 years, and it's from the seller. So that it'll sit in your escrow account, and then that you'll see it get supplemented in. So you'll see your actual real payment. If let's say your real payment's $2,000 at 6%, you'll see the $400 contribution from the seller coming from that money.
That escrow account, it just kind of sits there. See, so then, and like, let's just say, I know, when Sweetie Pie and I got approved to buy a home, we were approved up to a certain amount. So let's say 500,000, but I knew I only wanted to buy a house for 300,000.
Yeah.
So there's a lot of people who are pre-approved on paper for more than what they're actually comfortable with.
A lot of the times. Yeah.
But that worries me too, because then I'm like, okay, all these people who are pre-approved at 6% thinking the interest rates are going to go down, and then they're at 4 and then 5, and then they're going to hit that 6%, and it's like, oh shit, like, we're going to live off of top ramen and mac and cheese and hot dogs. Which nothing against mac and cheese and hot dogs, but like, I don't want to say it worries me, but I definitely keep that into consideration, where it's like, either we're going to see more consumer holdback in their spending when it comes to vacations, foods, going out to eat, that sort of thing, or we're going to see people selling their homes because they're just like, this is just insanity. Yeah.
And you might see that wave of people, if they don't get that refinance relief, sell their homes. But like before, they 100% qualify off of the 6%. So it would be a personal preference,
For sure.
Yeah. And nowadays it's
consumer-based.
kind of a weird economy where it's like, well, you need a couple $100, you can Uber or you can DoorDash or there's just things that didn't exist, in 2008 where you couldn't just, I'll just pick up a little extra money on the side. Now that is something that people can just do.
That's so true.
Which is kind of crazy, and it's going to be weird how that affects the market.
I think it'll be awesome, and I think that's great that there's more opportunity for people to make money. I mean, I think the hardest part is getting past people's egos, right?
Yeah.
Oh, you drive Uber? I mean, and how many times have I jumped in an Uber and they're like, oh yeah, I sell real estate on the side too. I'm like, okay.
Yeah.
Like, how can I help you? I sell real estate too. Like, let's, get this. So you don't have to Uber, but in the meantime, you're doing what you have to do to put food on the table and pay your bills.
Yeah.
I'm here for it.
Yeah, exactly.
Josh, you were amazing. Thank you so much.
Thank you for
Side note,
having me.
you totally waited an hour, and I apologize.
No, you're totally good.
We get backed up on days sometimes, so I apologize. But thank you for being my friend. I appreciate you being here today, and thank you for your knowledge. I'm sure we will have tons of questions, so I'll be sure and send them your way because I don't answer the lending questions.
I got you.
Thanks, friend.
Perfect. Thank you.